Right, I think we did up to the question number 5 the other day. As I remember, yes, this is the one we did last. We'll go ahead with question number 6. Let's go to the next page. Right, this is the question. Let me share the poll. You can start. Question number 6. Right, I've got 4 responses. Let's see the question. Which is the following is not an implication of market dislocation. Market dislocation, right? Bank profits subsequently falling. Consumers cannot obtain mortgages. Central banks use interest rates as an economic lever. Bank profits fail. The question is, which is not an implication, right? So we have discussed. Market dislocation means the organizations or the borrowers cannot borrow. They can't find markets. They can't deal. That's the idea. So that happens in that kind of situation. There's no point in losing or using the interest rate as a lever. We have discussed this. Not an implication of market dislocation, right? So the correct answer is central banks use interest rate as an economic lever. I think majority of you have given the correct answer. Good. Answer is C. Let's go to question number 7. Right, I've got 4 responses by now. Let's look at the question. Which of the following is not a technique used for the analysis of funding liquidity risk? Right? Not a technique used for the analysis of funding liquidity risk. Liquidity gap analysis, expected future funding requirement, yield curve, stress testing. So we have discussed all these, right? So these are all liquidity gap, expected future funding requirement, stress test, all those are used. But what is not used is the yield curve. Yield curve has nothing to do with the funding liquidity. That is to do with the investments. Right? Therefore, the correct answer is yield curve C. Right. Question number 8. Right, let's see. Only 2 people have responded. This is a difficult question. Let's see. The question is, what financial questions form the distribution for LAR? What is LAR? That is liquidity at risk. Right? Liquidity at risk. Historical funding requirements, predicted future funding requirements, statistical analysis, stress testing. So this liquidity at risk distribution is always based on the historical data that will be predicted for future. That's how we do this. So the correct answer is historical funding requirements. That is A. So okay, these are somewhat extreme questions. If you don't get right, don't worry. We'll see other. Okay. Go to question number 9. Right, I've got 5 responses this time. Very good. Let's see. Question number 9. Which of the following is false about market depth? So the question is false, right? Which one is false? It measures the volume of transaction needed to move prices. The higher the volume, the deeper the market. Selling in a shallow market will cause prices to fall. It is sensitive to price movements as well as volume movements. Following is false, right? False about market depth. What is market depth? Market depth is a measure of volume of transaction. We discussed this. Volume of transaction needed to move a price, right? If it is, if the depth is there, it requires more volume of transactions. So deeper the market, higher the volume. That's the idea, right? Now the question is, which of the following is false about that? So volume, it measures the volume of transactions that need to move prices. Yes, that's the definition. Therefore, it's true. The higher the volume, the deeper the market. That is also true. Selling in a shallow market will cause prices to fall. That is also true, because when you try to sell in a shallow market that is not deep, there is less demand, so prices can fall. Then it's sensitive to price movements as well as volume movements. Now, it is more about volume than price. So that market depth is about volume, right? Price is a different thing. So therefore, the correct answer here, which is false about market depth, is the last one, right? It's incorrect. So the correct answer is D. It goes with the definition and application, right? Question number 10. Right. Let's see question. Which of the following is a limitation of bit of a spread? Bit of a spread. The question is about limitation. They cannot be used to analyze market liquidity. They include transaction costs. They are difficult to understand. They are unpredictable. Uh, when you say bit of a spread, the question is about limitation, right? What is a limitation? Limitation is not about true or false. It's about when you have this model or whatever, so there is an inherent feature that is negative or that is detrimental, that is unfavorable. That is what we mean by limitation, right? So limitation is in the bits of a spread, they include transaction cost as well. So that's the limitation. So the correct answer is B. B. The limitation is they include transaction cost. Okay, let's go to question number 11. Right, I still have only 3 responses. Still have 3 responses anyway, because in the source of time, let me look at it. What's the issue? Which of the following is not the key measure of asset liquidity? Right, asset liquidity, market depth, immediacy, resilience, contagion. So I think the first 3 are connected to liquidity, but contagion is something else, right? Contagion is nothing to do with the liquidity, right? That's a different concept, totally different concept. So therefore, the correct answer is D, right? Let's go to question number 12. Right, I've got 3 responses. Took some time for you all to respond, but anyway, now that I got 3 responses, let's see. Which of the following is the best definition of market dislocation? So we discussed earlier market dislocation, right? When market liquidity disappears, when market liquidity slows, when market liquidity is isolated from other risk, when market liquidity is kick-started by the Bank of England. So last one has something to do with market dislocation is when there is no liquidity. That's what I think we discussed. When the liquidity is not there in the market, right? When there is no adequate funds, right, in the market, however much the central bank tries to manage the situation with interest rate adjustments, it won't work because however much the rate moves, there is no liquidity to enable transactions. That's what we call market dislocation, absence of liquidity. So the correct answer is A. Right. Okay, let's go to 13. Right, I got four responses. Which of the following is not true of bid offer spreads? Not true. Bid is the buy price, offer is the ask price. Wider spread means less competition. Smaller spread means less liquid market. Yes, the last one is the correct answer. All of you have given the correct answer. Very good. Next question, 14. I only have two responses. Let's see what the question is. Funding, liability, liquidity risk. Funding or liability, liquidity. Those are the same. Funding or liability is the same. Liquidity risk is best described as perceived risk that a bank may need emergency funding, inability to transform assets into cash, loss resulting from counterparty default, insufficient cash to cover short-term liabilities. The correct answer is funding or liability liquidity. So the answer is perceived risk that a bank may need emergency funding. So risk is that, right? When you need emergency funding, there is no adequate liquidity. That's the idea. So therefore, the correct answer is A. Right. 15. Right, I've got three responses. Which one of the following is not a key measure of asset liquidity test? This is asset, huh? Not a key measure. Resilience, diversification, market depth, immediacy. I think it's very easy. We discussed the liquidity related components. So it's the diversification. Diversification is the is a measure when you look at portfolios, right? So it has nothing to do with this. So the correct answer is B. Right. 16. Right, let's see. I've got 4 responses by now. Uh, which of the following would not be considered when using the method of expected future funding requirement to analyze funding liquidity risk? Not, not considered, right? Historical patterns, cost of the analysis, high-level business projections, customer assessment. It's about when you assess the future funding liquidities, right? Yeah. So I think the obvious answer is cost of the analysis, because you will not consider how much it costs you to do the analysis. That's a different story, right? That is not a consideration when you assess the risk. You have to assess the risk with the correct method. So the correct answer is B, cost of the analysis. This one is a little, I don't know whether you can read it. You can zoom it and see it, right? Otherwise, I can't show it. Question number 70. I've got, okay, the fourth answer, somebody is asking fourth answer, that is all of the above, right? Let's see the question. I know it's a little difficult because space is not adequate, but let's see the question. Which of the following are among the 4 common funding sources for a bank? Common funding sources for a bank. Wholesale money market, securitization on loan portfolios, retail deposits, facilitation with Bank of England. Yeah, these are all different sources of funding, right? Technically. So The correct answer is all of the above. All of the above. Right. Let's go to the next one. 18. Right. Got three responses. Let's see the question. What sort of cash flows does a maturity ladder compare? It's about maturity ladder, right? Inflows and outflows on a daily basis over a series of specified time periods. Inflows and outflows on a monthly basis over a series of specified time periods. Inflows and outflows on a yearly basis. Outflows on a monthly basis over a series of specified. So it's about maturity ladder. Technically, a maturity ladder is done on a daily basis. That's generally how it is done. Then we have various other techniques which falls in various longer term brackets. Right? The correct answer therefore is A. 90. Right, I've got 3 responses. Let's see the question. 19. Asset liquidity risk is best defined as asset liquidity, right? Not funding. Perceived risk that a bank may need emergency funding, that is funding liquidity risk, right? That is not the one. Inability to transform assets into cash, that sounds good. Loss resulting from counterparty default, no, that is credit risk. Insufficient cash to cover short-term liabilities, that is again funding side. So asset liquidity is covered in B, that is inability to transform asset into cash. Right. So that's the end of this paper. Uh, I don't intend taking a long break, but we'll take about 15 minutes break. Then we'll go to another paper. Uh, are you able to see my screen? Can you see my screen? Let me try again. Are you able to see the screen now? Can someone respond, please? I'm trying to.
Yes, sir. Can see.
Okay, great. So we go to chapter 8. I have a technical problem in running the poll. I suggest that you use the chat box in responding. Right, so we'll go it that way. Okay, question number 1. Use the chat box, huh?
So the first question is covered, sir. Can't see the full question.
Sorry. Can you see now? Okay.
No, sir, it's covered with your screen, sir. Can't see the full screen, full question.
Hold on.
Screen is small, sir.
I ran out of my battery. Let me see. Let me rejoin. Give me 2 minutes. I'll quickly rejoin. How is it now?
Yes, sir.
Right, great. Then start with the question number 1. I'll send the poll. Okay, question number 1. Well, I've got only two responses. So let's see the question. What are the benefits of separating inputs from formula when building financial models in Excel? This is a very basic question on Excel. Adds flexibility, ability to run multiple scenarios, changes in assumptions flow through the model automatically. Sensitivity analysis can be built into the model. One only, one and two only, one, two, and three only, all the above. If you look at the given points, I think all of them are helpful, right? They are part of it. So the correct answer is D. Correct answer is D. Great. Let's go to the next question. All right, let's see. I've got four responses. Let's see the question. All of the following are limiting assumptions that can be made when firms build their models apart from, right? Apart from which one? So these are limiting assumption apart from one. The relationship between the past and future, the state of the business environment at the point when the model was designed, the capital required to cover the potential scenarios, the shape of any underlying distribution used by the model. Right? If you if you look at the given responses, there's one thing that is not connected to these limiting assumptions. That is the capital required to cover the potential scenarios, because capital required to cover the potential scenarios is a separate model, right? That has nothing to do with the scenarios building, right? So the correct answer is C, right? Let's go to question number. But I've got 3 responses to the question. Let's see what the question is. Which function is responsible for assessing the overall effectiveness of the model risk management framework? Chief Risk Officer, Board Director, Senior Management, Internal Audit. Remember, wherever the effectiveness is involved, that is always audit, right? Don't forget this, the keyword. Wherever effectiveness is involved, that is always audit. Right? So correct answer is D. Let's go to question number 4. I got only one response up to now. Is it a difficult one? Okay, just two. Okay, let's see. Which of the following is not a common assumption that can be produced inaccurate credit risk calculation and inaccuracies in the risk model? All right, not a common assumption, right? Not a common assumption that can be produced inaccurate credit risk using simplified calculations for current exposure. Assuming that some exposure have equal credit risk. Assuming that default risk stays the same over time. A lack of recognition of portfolio diversification. If you read the given four, right, what you understand is not a common assumption that can produce inaccurate credit risk. So B and C are not there because they are anyway common assumptions. Lack of recognition of portfolio diversification, that is a limitation, not an assumption. Using simplified calculation for current exposure. So that is not an assumption we can consider. So this is a little tricky one, but the correct answer is A. Right? And I think for some reason there is a problem in the questions in the middle and only the answers are there. Well, anyway, in the interest of time, let's go with the question number 8. I think middle couple of questions are missing. Right, I've got 3 responses. Let's see the question. Risk workshop outputs are primarily aimed to capture estimates of each following scenarios. Apart from which one? So we need to find the odd one, right? Apart from which one? That's the question. The time period over which a scenario might occur, average loss were it to occur, the frequency with which such scenario might occur, the severity of the loss that could occur in an extreme case. So when we look at in the workshops, we are trying to identify the risk incidents and the loss implication, the severity, and the frequency will give you the probability. Right? So the three things: the loss given default, that's the probability, right? And the actual loss amount and the severity, the impact. But time period is not a consideration, right? Time period over which it will occur is not a consideration. So therefore, the correct answer A for the question. The correct answer for the question is A. Okay, let's go to question number 9. And I've got 3 responses. Let's see the question. Which one of the following tests the accuracy of risk models against extreme market event scenarios? Right? Accuracy against extreme market. So we look at different scenarios. No, sorry. Yeah, extreme market. Back testing, correlation simulation, stress testing, historical simulation. So in an extreme situation, what we do is we identify situations that can occur and then we test. There are 2 things we look at. We look at scenario testing and stress testing. We look at these situations. But out of the 2, we can only see stress testing here. Back testing is looking back to the actuals versus the predicted model, that part. Correlation simulation is about looking at the link between 2 variables. Historical simulation is looking at historical data and see the predictions. The question is about extreme situation. Extreme situation, we assume abnormal situation, no things that might occur. So we look at stress testing and scenario testing. So from the given list, what is relevant is stress testing. Okay, then we get to the last question. I've got only 2 responses. The last question. Let's see. Which model of testing VR uses extreme market events against the model? Model risk, back testing, stress testing, operational risk. If you look at the previous question, is more or less a repetition of the same concept, right? Whatever the method, when you look at extreme events against the model. Extreme events, again, the same thing, but we discussed previously. Either scenario, stress, again, they're asking similar to model risk, back testing, stress testing, operational risk. The correct answer is C, stress testing. Right, so that's the end of this paper, and time is also up. With that, I conclude. I have only 2 more chapters to go. Probably next week we can finish it off, and we'll see how we move on afterwards. Right, good night.
Thank you, sir. Good night.
Thank you, sir. Good night.